Hi everyone, I am Sarathamani, Assistant Professor, Department of Commerce. Today we discussed about investment planning in personal financial planning. Okay, investment planning is the process of identifying financial goals and converting them to building a plan. Investment planning is the main component of financial planning. The investment planning begins with identification of goals and objectives. Then we need to match those goals with our available financial resources. Okay, nowadays there are many investment vehicles to invest in, most common being cash, equity, bond and property. So accordingly to the fund available, we can invest in these vehicles to obtain our goal and objectives. Benefits of investment planning, that is family security, efficiently manage income, financial understanding, savings, standard of living. The objectives of the financial plannings are safety, income, growth of capital, tax maximization, and liquidation. Okay, and in the steps of investment plans are, before investing in any investment vehicle, a solid investment plan is required. If we do not plan, then all our investment will turn into a mess. Planning is very important step before investing. The first step is find when and how much you are saving. This is the first of the investment planning. As soon as we are employed, we should start saving. Whatever our salary is, we should not spend all of all at it and start saving to our retirement and unforeseen emergencies. There can be many unforeseen emergencies in our life, such as life-threatening diseases, which savings are important. We should also determine how much to keep aside every month for our savings. The next step is set your financial goals. We need to identify our short-term as well as long-term goals. This is how we start goal setting in investment planning. Our goal can be saving for a vaccination or buying some gadgets which we really want to own. Okay, for example, different goals are required to in different investment planning, like for retirement, for child education, for child's higher education, for child's marriage, for buying a house, for create emergency funds. Okay, the third step is analysis your risk taking ability. We should know our risk taking aptitude. If we have just start earning, then our risk taking aptitude is very less. We should invest in those investment vehicles which has less, like fixed deposits. People who have ample money to save, their risk taking appreciate in more. They should invest in those investment products which have higher risk, like investing in index stocks or mutual funds. Okay, the next step is create a savings portfolio. After determining goals and risk taking appreciate, the next step in investment plan is to create a saving portfolio. One should have a diverse portfolio which should include many investments vehicles such as stocks, gold, bonds, fixed deposit, real estate, etc. The main purpose to have a diversity portfolio is to diversity the risk associated with investment vehicles. And the fifth step is learn about all investment options. Before we start investing in, we need to learn about all the investment options available in the financial market. We need to go through the all investment vehicles such stocks, bonds, gold, real estate, life insurance, etc. Okay, The next is calculate your asset allocation. This take a main important role in investment planning. Okay, the investor can select from the various asset classes available in the financial market and allocate assets in such a way that it achieves optimum diversification while targeting the expected returns. The investigators can assign percentage to various assets classes such as stock, gold, real estate, bonds, etc. The last one is know how to build your portfolio. The most important step in investment planning is implementing the portfolio plan. After we implement our portfolio plan, the management process begins. It is necessary to monitor the investment performance regularly, most quarterly, and review the portfolio plan annual. The investor goals and situation should be reviewed once a year to determine whether there or any significant changes. Okay, this may be considered as the last step of investment planning. Okay, thank you for watching my video.